Welcome, financial explorers, to a deep dive into the fascinating, often tumultuous world where traditional economics meets the cutting edge of cryptocurrency. Today, we're not just scratching the surface, we're excavating the core trends, the underlying news, and the subtle shifts that are redefining our financial future. From the inflationary pressures squeezing household budgets to the unprecedented institutional embrace of digital assets, every ripple in the global economy sends waves through the crypto market. Whether you're a seasoned investor or just beginning to understand the blockchain, comprehending these interconnected forces is paramount. We'll unpack the intricate dance between central bank policies and Bitcoin's volatility, explore the rise of altcoins, and cast a critical eye on where this journey might take us next. So buckle up, because understanding these dynamics isn't just about making money, it's about navigating the future of wealth. Throughout this comprehensive session, we'll meticulously dissect the most pressing topics shaping both the macroeconomic landscape and the cryptocurrency ecosystem. Our journey begins with a hard look at global inflation and the Federal Reserve's response, especially through interest rate hikes, and how these actions reverberate across risk assets. Then, we'll pivot to the crypto specifics, Bitcoin's market dominance, the impending halving event, and the dynamic performance of altcoins, with a spotlight on emerging sectors like DeFi, NFTs, and AI tokens. We'll also examine the accelerating pace of institutional adoption and the evolving regulatory frameworks worldwide, before grounding our understanding in historical context. Finally, we'll project future outlooks, discussing spot ETFs, technological advancements, and geopolitical influences. This isn't just news, it's an actionable framework for understanding tomorrow's economy. Let's kick things off by addressing the elephant in the room: global macroeconomic headwinds. Inflation has stubbornly persisted, challenging central banks worldwide and forcing aggressive monetary policy responses. We're talking about interest rate hikes that have dramatically altered the cost of capital and, consequently, investor appetites for risk. When borrowing becomes more expensive, capital tends to flow out of speculative assets and into safer havens, or simply stays on the sidelines. This tightening liquidity directly impacts cryptocurrency markets, which are inherently more volatile and sensitive to changes in economic sentiment. Understanding this fundamental correlation between central bank actions and crypto performance is crucial for predicting market movements. We've seen this play out multiple times, where the Fed's rhetoric alone can send ripples through the entire digital asset space, underscoring the deep integration of crypto into the broader financial system. Now, let's turn our attention to the king of crypto, Bitcoin. Bitcoin's market dominance has always been a key indicator of market sentiment, often acting as a barometer for the broader digital asset space. Its recent performance, navigating through macroeconomic uncertainties, has reinforced its position as a foundational asset. But perhaps the most talked about event on the horizon is the upcoming Bitcoin halving. For the uninitiated, the halving is a programmed event that slashes the reward for mining new blocks by half, effectively reducing the supply of new Bitcoin entering the market. Historically, these halvings have preceded significant bull runs, creating a supply shock that, when met with sustained demand, has propelled prices to new highs. We are on the cusp of another such event, and investors are keenly watching to see if history will rhyme once again. The anticipation is palpable, as this fundamental supply-side mechanic remains a powerful force in Bitcoin's price discovery. Beyond Bitcoin, the altcoin market is a vibrant, diverse ecosystem, constantly evolving and innovating. While some altcoins follow Bitcoin's lead, many carve out their own niches, driven by unique technological advancements or specific use cases. We're seeing significant movements in decentralized finance, or DeFi, with new protocols emerging that offer innovative lending, borrowing, and trading solutions challenging traditional banking models. NFTs, or non-fungible tokens, continue to evolve beyond just digital art, finding utility in gaming, digital identity, and real-world asset tokenization. And perhaps most excitingly, the convergence of AI and blockchain is giving rise to a new class of AI tokens, powering decentralized AI networks and data marketplaces. However, each of these sectors carries its own set of risks and rewards, demanding a nuanced understanding of their underlying technology and market dynamics. It's a landscape of constant innovation, but also one that requires careful due diligence. One of the most significant shifts we've witnessed recently is the accelerating pace of institutional adoption. Major financial institutions, from hedge funds to large corporations, are no longer just observing. They are actively integrating digital assets into their portfolios and services. This institutional influx brings massive capital, but also demands greater regulatory clarity. The regulatory landscape, therefore, is maturing at an unprecedented rate. Governments and financial watchdogs worldwide are grappling with how to classify, oversee, and integrate cryptocurrencies into existing financial frameworks. We're seeing proposals for comprehensive crypto legislation, discussions around market integrity, and efforts to prevent illicit finance. This push for clearer rules, while sometimes seen as restrictive, is ultimately paving the way for broader mainstream acceptance and institutional comfort, transforming crypto from a fringe asset to a recognized financial class. The stakes are incredibly high, as these decisions will shape the future structure of the global financial system. Integral to the crypto ecosystem, yet often overlooked, are stablecoins. These digital assets are pegged to traditional currencies like the US dollar, acting as a crucial bridge between volatile cryptocurrencies and stable fiat. They facilitate trading, provide liquidity, and offer a safe haven during market downturns. However, their increasing prominence has also drawn the attention of central banks, who are now aggressively exploring and developing central bank digital currencies, or CBDCs. While stablecoins are typically issued by private entities, CBDCs would be direct liabilities of central banks, essentially digital versions of national fiat currency. The race to develop these digital currencies is on, with implications for monetary policy, financial inclusion, and privacy. Understanding the distinctions and potential impacts of both stablecoins and CBDCs is vital, as they represent the future of digital money, each with its own advantages, risks, and philosophical underpinnings regarding control and decentralization. This is a battle for the very nature of money itself. To truly grasp where we're headed, we must first understand where we've been. The crypto market is notorious for its cycles of explosive growth followed by sharp corrections, often termed bull and bear markets. Think back to the ICO craze of 2017, the subsequent crypto winter, and then the dramatic bull run of 2021, fueled by institutional interest and pandemic-era liquidity. Each cycle offers invaluable lessons. We learn about market psychology, the impact of retail versus institutional FOMO, and the importance of technological fundamentals over hype. Analyzing these past cycles reveals recurring patterns: moments of irrational exuberance, periods of capitulation, and times of quiet accumulation. By studying these historical data points and investor behaviors, we can better identify where we might be in the current cycle and make more informed decisions, rather than being swept away by the latest narrative. History, in crypto, doesn't always repeat, but it certainly rhymes loudly. Beyond its inherent volatility, cryptocurrency has demonstrated a surprising resilience, often navigating periods of significant traditional economic shocks with unique characteristics. While it often correlates with broader risk assets, there have been moments where Bitcoin, in particular, has been touted as a digital gold or a hedge against inflation and currency debasement. During times of geopolitical uncertainty or sovereign debt crises, some investors have historically flocked to decentralized assets, seeking refuge from traditional financial system vulnerabilities. However, it's a nuanced discussion. The narrative of crypto as a pure safe haven is challenged during broader market liquidity crises, where everything, including crypto, can see sell-offs. Yet its underlying censorship resistance and permissionless nature continue to offer a compelling alternative to centralized financial systems, making it a critical asset to monitor during times of economic turbulence. Its capacity to weather storms, even if with some turbulence, is a testament to its evolving role in global finance. Looking ahead, one of the most transformative developments for crypto's future is the approval and success of Spot Bitcoin ETFs and potentially Spot Ethereum ETFs. These exchange-traded funds represent a seismic shift, making it significantly easier for mainstream investors and large institutions to gain exposure to Bitcoin without directly holding the asset. This dramatically lowers the barrier to entry, integrating crypto seamlessly into traditional brokerage accounts and retirement funds. The influx of capital from these new avenues is not just theoretical, we've already seen substantial flows. This increased accessibility legitimizes crypto further in the eyes of traditional finance and regulators, opening the floodgates for wider adoption. It's a clear signal that digital assets are moving from the periphery to the core of investment portfolios, fundamentally altering market structure and liquidity. The future of crypto's integration into traditional finance is here, and it's being traded on Wall Street. The future of crypto is not just about price, it's profoundly shaped by ongoing technological advancements. We're seeing incredible progress in scalability solutions, particularly Layer 2 networks like Optimism, Arbitrum, and ZeekSync, which enable faster and cheaper transactions, making blockchain applications more user-friendly and accessible. Beyond speed, privacy-enhancing technologies are gaining traction, offering users more control over their data and transactions, addressing concerns about surveillance and financial censorship. Cross-chain interoperability is another critical frontier, allowing different blockchains to communicate and transfer assets seamlessly, unlocking unprecedented possibilities for decentralized applications. These innovations are solving the inherent limitations of early blockchain designs, expanding the utility of digital assets far beyond simple speculative investments. They are building the infrastructure for a truly decentralized, efficient, and private digital economy, pushing the boundaries of what's possible in a trustless environment. Finally, we cannot ignore the profound influence of geopolitical factors and the varying global adoption rates on the cryptocurrency landscape. National policies, international sanctions, and differing regulatory approaches across countries directly impact where crypto innovation thrives and where it faces headwinds. Some nations are embracing blockchain technology, fostering innovation hubs and attracting talent, while others are imposing stricter controls or even outright bans, driven by concerns over financial stability, capital flight, or national security. The crypto-friendly versus crypto-restrictive narratives are constantly evolving, influencing investment flows, project development, and the global distribution of digital wealth. This fragmented global approach means that understanding the geopolitical chessboard is as important as understanding market charts, as international relations and national economic strategies increasingly intersect with the decentralized world of crypto, shaping its very trajectory on the world stage. In such a dynamic and often unpredictable market, effective risk assessment and a well-defined investment strategy are paramount. Cryptocurrency remains a volatile asset class, and while the potential for significant returns is undeniable, so too are the risks. It's crucial to understand your individual risk tolerance and to never invest more than you can afford to lose. Diversification, not just within crypto but across your entire investment portfolio, is key. Conduct thorough due diligence on any project you consider, moving beyond mere hype to understand the underlying technology, team, and use case. Avoid common pitfalls like chasing pumps, succumbing to FOMO, or falling for scams. A long-term perspective, focusing on fundamental value and technological progress rather than short-term price swings, will serve you best. The crypto journey is a marathon, not a sprint, and informed, disciplined decisions are your greatest allies. So, as we bring this deep dive to a close, remember that the intersection of cryptocurrency and economic trends is a constantly evolving landscape. We've traversed the macroeconomic headwinds, unpacked Bitcoin's pivotal halving, explored the vibrant altcoin sectors, examined institutional adoption and regulatory shifts, and learned from historical cycles. The future promises further integration through spot ETFs, incredible technological advancements, and the ongoing dance with geopolitical factors. The key takeaway remains vigilance, continuous learning, and informed decision-making. The digital asset space offers unparalleled opportunities for those who understand its complexities and approach it with a strategic mindset. The revolution isn't coming, it's already here, reshaping finance one block at a time. Stay curious, stay informed, and always invest responsibly. Thank you for joining me on this essential journey into the future of money.